Hello and welcome to today's video. In today's video, we are going to take a look at how do the zero commission brokers, how do they make money? So there are a lot of zero commission brokers out there like Robinhood, Webull, etc. And they claim that they do not charge anything for executing transactions on their platform. And some of the brokers, they offer you free buying and selling of stocks, whereas brokers like Robinhood, they offer you even free option trades as well. So we'll dive a bit deep into this and we'll try to understand is how these brokers they basically make money when they are not charging you any fees or commission for trading. So this is what we will cover here, and we'll also try to understand, are these brokerages really free, or are you actually paying for the trading in some other way? Before we proceed, a quick look at the disclaimer, which states that any information that I'm sharing with you in this video is only for entertainment purposes. It is not any kind of trading or investment advice. If you plan to trade or you invest your money, then please get in touch with a certified financial advisor and understand the risks before taking any trades or investing your money. And I just want to have a quick call out that I'm sharing my trades, the ones that I take, uh, for free on the community tab of my channel. So if you want to access my trades, you can go to the community tab, and there you can see my trades. And we also keep a track of the overall profit and loss. And all you have to do in order to receive notifications about these trades is subscribe to the channel and enable the notifications. So as soon as I post a trade on the community tab, you will receive a notification and then you can view the trades. So hopefully this information which I'm sharing for free, most people charge money for this, but right now I'm not charging anything, and this should form a good learning experience. In order to get my trades for free, you can just go to my channel, Serene Trading Strategy, and once you're on the channel homepage, then you can go to the community tab over here, and here you can see that all trades are listed. So till now I have posted 41 trades, and some of these will show in the open status, which means this is an active trade and I have still not closed this particular trade, whereas some trades you will see will be closed. So these are older trades which have been, these positions have been closed. And so we have multiple open and closed trades mentioned here on various symbols that I have taken. And also for the close trades, what was the return, whether it was a profitable trade or a losing trade, what was the annualized return, how many days were there to expiry when I took the trade, and actually the trade was open for how many days, all those statistics are mentioned here. We also keep a track of the running loss or profit. So right now you can see this is a positive number. So there is a $4,052 profit till now. So if you want to follow my trades, you can follow this process, and hopefully you will find this helpful. So let's understand the different ways in which these so-called zero brokerage brokers, how do they make money? So first way they make money is by a technique called payment for order flow. So let's say you have a person A who wants to buy shares of a certain company, and at the same time you have a person B who wants to sell shares of the same company. And let's say that in a free market, if these two people were available, they knew each other, then they decided upon a price of $12.10 to execute the trade. So in that particular case, what will happen is that the person A would buy the shares for $12.10 per share, whereas the person B would be selling the shares for the same price, and that would complete the trade. But what happens is that since individual people cannot connect with each other, all of us trade through brokers. So the way the order travels is that every person, whether it is A or B, they place order with their brokers. The brokers forward these orders to institutions called market makers, and market makers are essentially big institutions who are always willing to take the other side of the trade. So, for example, I'll just give you an example why market makers are significant in the financial markets. Let's say the person A places a trade at 10 a.m. To buy shares, and the person B is wants to sell the shares, but he places the trade at 11 a.m. So for 1 hour, no trading can happen because there is no liquidity in the market. I'm taking an extreme example just to help understand the concept. So what will happen with the presence of the market makers is that at 10 a.m. itself, the market maker will give a quote at which the market maker is willing to complete the trade for A at 10 a.m. itself. So A doesn't have to wait till 11 a.m. for a counterparty to be present. The market makers will always act as the counterparties. So market makers provide a very essential service in the financial markets. They provide liquidity, and it's an important function. But along with this, what they do is they introduce the concept of the bid ask spread. So eventually, if you see, all trades should be matched at the exchange. But in payment to order flow, what happens is your broker is forwarding the order to these market makers, and then these market makers will give this bid and ask quote, as you can see in the bottom section of the screen. And in this case, I took a very liquid stock. This quote is actually for Verizon. So if you see here, there is a 1 cent difference between the bid and the ask price. That means if somebody wants to buy shares, they need to pay up $38.30, whereas if they want to sell the shares, they will receive only $38.29. So, so let's take this example itself, that person A wanted to buy the Verizon shares and person B wanted to sell the Verizon shares. Now, since both these orders will be taken care of by the market maker would in turn make a profit of 1 cent per share. Why? Because from A, they would be selling the shares at 38.30, whereas to B, the market maker would be purchasing the shares from B for 38.29. This gives a difference of 1 cent, which is the net profit for the market maker. So the entire business of market makers is dependent on capturing these profits from the bid ask spreads that exist. If stocks are very liquid, then the bid ask spread is lower. But if the stocks are not liquid, then the bid ask spreads can be really wide as well. So, with this understanding that market makers have every incentive to increase their volumes by as much as possible. So, one of the ways they do that is by incentivizing the brokers. So, what the market maker will say is, okay, they will reach out to different brokers like Robinhood, Webull, and others, and what they'll say is, you whatever orders you receive on your platform, you forward them to us, and in return, we if we make 1 cent, half of it we will share it with you. So we just saw an example where the market maker was making 1 cent per share. So what they can decide is that whichever broker forwards these orders to the market maker, they will share this profit of 1 cent, and half of the profit they will share with the brokers. So now brokers are incentivized to forward the orders to only this particular market maker, and market maker, based on their increased volumes, will make more and more profit. So it's a win-win situation for everybody. But if you really look at who's paying for all this, it is the end customer who wanted to buy and sell the shares. The buyer and the seller were in some manner, if they could connect with each other directly, then this bid ask spread would not be there, because they would arrive at a consensus price and the buy and the sell would happen at the same price. But because this market maker is involved, and it is an essential part of the process in order to have the liquidity in the markets, this bid ask spread is introduced, and this is the profit for the market makers. So one way, the primary way in which brokers nowadays they make a lot of money, is through payment for order flow. So different market makers will offer different kind of commissions to the brokers to forward the orders to them. So one market maker may offer 20% commission, another market maker may offer 30% commission. So brokers will make a lot of money using this technique. Now, this particular technique is objectionable in certain respects, because now the broker has no incentive to get the best price for the customers. Rather, the wider the bid ask spread, that means the more money actually the customers lose, the greater percentage of that bid ask spread can be given as a kickback to the broker. So in some countries, this practice has actually been banned because it is considered to be a conflict of interest with the actual purpose of the broker, which is to get the best price for their clients. So I'm just calling out the details here. This practice is still in, I mean, this is still in practice in the United States, and essentially this is one major technique through which the brokers now make a lot of money, especially when most of them are forced to offer commission free brokerages and commission free transactions because of the competition. So one broker gets into the commission free transactions, then everybody has to follow suit. But you can understand here that even if you are trading without paying any commissions, you're actually paying in a different way. So this is one technique used by the brokers. The second thing is that a lot of brokers, they offer you a bare bones service. So a minimum service is provided to you, which is essentially an electronic system or a platform or an app where you can go and place the trades. But they also offer you a higher tier. For example, in Robinhood, it's called the gold tier. So you can apply for that and then you get certain privileges. For example, if you try to deposit money in your accounts, then immediately, uh, instead of waiting for the transaction to settle down, let's say you just made a transfer from your bank account into the trading app. So it takes time for the bank to actually transfer the funds and the money to be settled before you can use it for making trades. So if you have this gold membership, then it becomes faster. You can use, I think, up to $5,000 or something immediately, and then the rest of the amount you can use as the bank transaction is settled. So these kind of perks and privileges are provided. Some brokers will provide you with additional reports where analysts give their recommendations and other things to help you in decision making. So you have a bare bones service provided by the brokers, and then a lot of brokers, they provide you additional services like reports and recommendations and additional assistance for a higher tier. So this is one way where brokers make some money. Then the third way brokers make money is through the trade execution assistance. So nowadays, most brokers, they provide you with an online platform where you can either access their platform using the browser on your computer or using an app on the phone or a tablet, and you can place your orders yourselves. But in an extreme situation, let's say you're traveling and you don't have access to a good internet connection, or you have some confusion and you want to execute a trade, so still the brokers, they give you a facility to call them up, and they can charge as much as like $50, $60, $100 to help you execute those trades. So this is another way by which brokers make money. If they provide any kind of a trade execution assistance, then they charge for it. In some cases, if you have a very large order and it's on a, I mean, relatively the liquidity of the stock is low, then it may take you, let's say you want to sell 100,000 shares of a company, or you want to buy 100,000 shares of a company which doesn't have very high trading volumes. So in this case, you may have to continuously sit and keep executing the trade and wait till it finishes. So if you don't want to do that, you want to take somebody's assistance to help you fill the order, then you can call up your broker and they will help you or assist you in filling up that order, which would take maybe 3 4 hours, but they will do the job for you. So again, any kind of trading assistance that they provide for execution of the trades, where you don't want to execute the trades yourself but you want somebody else to do it on your behalf, for that also brokers charge money. The next one is interest on the uninvested cash. Now, this is very interesting. So, all of us put some money in our trading accounts, and very often you will see that the entire sum is not invested. So, quite a bit of money is left uninvested, which is in the form of cash, because people, they transfer money into their trading accounts and sometimes they altogether stop trading, or they are waiting for a good opportunity to come up, which takes a couple of months to appear. So till that time, they don't withdraw money from their brokerage accounts, because for a normal retail investor, if you think about it, they have two options: that one, they can keep the money in their brokerage account, or secondly, they could keep the money in their bank account. And in the last few years, the interest rates have literally been at zero. So banks, if even if you keep it in a bank checking or a saving account, you literally don't get any interest. So there is no incentive for people to move the money out of the broker account and keep it in the bank account. So this cash is available. This is unutilized or uninvested cash, which is available in all the brokerage accounts. And for a broker, if you see which has millions of trading accounts, uh, you can understand that even if every account just has $100 of cash, uninvested cash available, and you have 10 million accounts, then this would the total would be $1 billion, and these $1 billion can be parked in the bank account of the broker. So although 0.1% or 0.2% interest on $100 is not much. It is not at all significant. But when you calculate the same percentage on a $1 billion deposit, it becomes a huge source of money. And I'm just looking at some broker having 10 million accounts and having $100 balance per user. In fact, the uninvested cash can be way higher. And so if brokers have this kind of cash, 20-30 billion dollars available, they can park it in a bank account or some kind of an interest account, where even a small amount of interest, because the amount is so huge, that can be a significant amount of income for the broker. So this is called as cash sweep, where the broker will take the uninvested cash and park it into one of their accounts, which could be a bank account or some other type of account, which is going to yield interest on it. The fifth way that brokers make money is on margin lending. So a lot of brokers, let's say you have $10,000 in your trading account, but they will allow you to take trades where they will ask for a certain amount of margin. But let's say you can buy shares worth $20,000. So what is happening is you are using $10,000 of your own money, but you are using $10,000 of the broker's money, and this extra money is being lent to you by the broker. And so your account is actually levered up. It's on leverage, and the additional funds that the broker is lending you, they will charge you a certain interest on it. So this is another source of income for the brokers, and it's a pretty safe technique for them, because they do these margin calculations and they keep a lot of safety for themselves, so that if you start taking losses, so let's say you put $10,000 of your own money and they give you additional $10,000, so you have a total position worth $20,000. So if your position goes down in value by $4,000 to, let's say, $16,000, this $4,000 will be deducted from your cash balance. So your balance will go down from 10 to 4,000, and the broker's $10,000 is still safe. So they always keep this margin of safety. If the balance becomes too low, or there is a risk that broker can start losing their money, so either they'll give you a margin call, they'll ask you to deposit more funds, or they will simply liquidate the position and protect their capital. The sixth way is using stock loans. So um, the stock loans, in order to understand that, you have to understand the concept of shorting of stocks. So when somebody shorts the stocks, then the normal process is that you first buy the shares and then you sell them later. But shorting means that you are selling the shares which you don't own. So in this case, where do the shares come from? So you are selling something which you don't even own. These shares are actually borrowed from the broker. And so whenever there is a short position, the broker is actually lending you their shares, and for this they can charge you a certain amount of money, and this is called a stock loan. So the shares that the broker has been loaned to you, and in fact the broker doesn't usually have their own shares, so they are taking the shares out of somebody else's account. If you see some broker, so I'll give you an example. Let's say there is a person A who has 1,000 shares of Citibank in their account, right? And they want to have a long position, they want to hold the shares, and there's a person B who wants to go short that position. So what the broker can do is they can take the shares from A's account and lend it to B, because B is going to take a short position. B needs to borrow the shares from somewhere, so that somewhere is going to be person A, but B and A don't interact directly with each other. It's through the broker. So broker essentially is taking the shares from the pool of its clients who are long that position and giving it to people who want to go short, and then B can sell the shares and later they can buy them back. Now the funds are maintained in B's accounts to make sure that the shares can be bought back at a later time, and a lot of brokers will give an incentive to A that if you allow lending of your shares, we'll pay you, let's say, 0.5% or 0.25% return per month on the shares that you have lent. So what will happen is that broker will pay 0.25% to A for lending the shares, but the same broker will charge 0.5% to B for providing this service. So the difference between these two percentages, that is another 0.25%, is the net money that the broker is going to make. This was just an example, these are not actual figures, but I hope I've clarified the concept that they can pick up shares from people who are holding them and loan them to others who want to take a short position. And the first party gets paid because they are loaning their shares. The second party pays up because they are borrowing the shares. And The rates of lending and borrowing are slightly different. They are structured in such a way so that broker can keep their own margins in between and they make money out of it. The final technique by which brokers make money is through account transfer charges. So, for example, this usually applies if you want to migrate from one broker to another broker. So mostly brokers, when let's say I have an account with broker A and I'm migrating it to broker B because I'm getting better commission rates or I like their platform or for whatever reasons, then B is not going to charge me most of the times because they're getting my business, right? So they're going to make money off the trades that I'm going to execute. So when it is an account being transferred inwards to their platform, brokers usually don't have any charges. But if you try to move your account from one broker to another broker without liquidating your positions, then in that case, most brokers they charge you a lot of money to do that. And so those are kind of one-time charges because eventually you're going to be closing the account. But those one-time charges are pretty hefty, and they can be as high as like $100 $150 for the complete transfer of the accounts. And so that is another way of earning for the brokers. So even when accounts are getting closed, which is a regular process, some accounts for every broker will eventually get closed and people will migrate to other platforms. So even when that happens, brokers find a way of making money off it. So most people don't even get to understand that these are charges or they will have to pay up unless they have to move to another broker and they decide to close their accounts. So these were the different ways in which brokers can make money without charging commissions. If you see, I have covered all the various ways in which brokers make money, but commissions are not included here. So if you were wondering how these zero commission brokers actually survive and they have such huge companies with billions of dollars valuation and market capitalizations and with such huge support teams and infrastructure, the platform, how do they maintain all this without charging you any money? It's not all for free. There are various ways that the brokers can make money, and it's usually using the resources, either the shares or the unutilized cash, uninvested cash, or offering a suboptimal pricing to the end customer. So, as an end customer, you may feel that you're not paying any commissions or any charges, but one way or the other, you are actually paying the broker because they are making money. These are, end of the day, these are um, institutions which have an objective to make and maximize their profits in every possible way. And so it's more of a, I would say, a marketing gimmick saying that this is a zero commission brokerage account because there are other ways in which the uh, end customers are made to pay. The only thing is that all this is in the fine print, and most people don't even realize that when they execute trades on a zero commission broker, there are other ways through which money is still being made by the broker, and the party taking care of those expenses is actually the end client executing the trades. So I hope this video was useful, gives you an insight on how the so-called zero brokerage brokers, they are still making hundreds of millions of dollars every single year. If you have any queries around this or if you have any suggestions, please leave them down in the comment section. I will definitely respond to you. If you like the video, please like the video, subscribe to the channel, and share this with your family and friends. And I'll catch you guys in the next video. Thank you.